Thank you very much. So welcome. My name is Aleksandar Andonov. I'm from University of Amsterdam. This is a joint work with Mike Mao, who is now in Australia, but a former colleague from the Dutch academia. So we'll look at 401k plans.
Make it sound like he's been exiled.
So we'll look at 401k plans and allocation and try to distinguish allocation between different firm types based on the industry where they belong. So to start with, I think in general, let's say the defined contribution system are the dominant form of saving for retirement, especially in the private sector in US. In the other countries, there is also growing attention for them. So depending on whether you define a system as a defined contribution, I think they have been established, especially in Australia, Chile, Sweden. Within the US, let's say one of the major forms are 401k plans. The account, I think I checked from the Investment Company Institute, the latest statistic was 5.8 trillion, like the end of Q2 2019. So that would be roughly approximately equal to the amount of assets under management by defined benefit US public sector pension funds. I have spent a lot of research on them. So in terms of money, they will be at this stage approximately equally important. What is special is that the 401k plans, let's say in the DC spectrum, will be on the, let's say, the side which gives most power to individual participants. So they can decide whether to be part of it or not. If they're part of it, they can decide how much to contribute or not. Once they are in, they can decide how to invest their, let's say, savings. So they can choose within a menu of options. So out of this decision, so that the decision-making power on the individual side is huge. In this paper, we look primarily on the investments. So given that there is a menu of options, we try to understand like what kind of options are offered to them, and then the allocation decisions they make. And I think in that process, there are, at least we think, three agents play a major role. So we start with like the sponsoring company. So this is the employer that establishes the 401k plan. The second one is what we call a trustee or a financial firm that is servicing kind of the plan. And that one is also involved in the process of designing the menu of available options. And the third one is plan participants. And the plan participants then have basically the decision-making power to allocate their savings within the available options. So this setup, I think, creates some potential conflicts of interest. The idea is that, of course, the sponsor and the trustee have the fiduciary duty to act in the best interest of plan participants. So they're obliged to try to design the best possible menu to offer to their participants and to help them achieve good retirement outcomes. However, especially the trustees, I think they have conflicting incentives to basically design this menu in a way to benefit the affiliated company, whether it's the sponsor or the trustee, typically at the expense of plan participants. So there have been several papers on what kind of options are offered and where these funds, how the relation between the investments of the funds that are on the menu and how much they invest in the sponsoring company, or that the trustee has incentives to keep own mutual funds longer on the menu to kind of give them a little bit of favoritism. This wouldn't matter if the participants can see through this and sort of like adjust their investments accordingly, and if they have enough, let's say, options to adjust it. However, there is a large literature that says that plan participants find this process very hard, and it is a hard process. So they're definitely not able to fully overcome the inefficiencies in the menu design. So that's why, let's say, when we look at their decisions, we will see that basically we can achieve better outcomes. Some, let's say, way to improve it is, we talked a lot in the previous sessions about financial education, increasing financial literacy, and I think within defined contribution retirement system, financial literacy has been related to many, let's say, desirable outcomes, whether we talk about accumulated wealth at the end or the initial enrollments, participation in the plan, and if they decide to participate, the contribution rate, etc. So I think this suggests that financial literacy basically helps participants achieve better outcomes. And the question that we try to ask is like how successful financial literacy is identifying, let's say, and mitigating a little bit conflicts of interest in the DC menus. So to start with, we make one broad assumption. Our idea to measure financial literacy, we don't run surveys, we don't ask participants to answer questions, we make an assumption that the sponsoring companies and employees of financial companies are relatively more financially sophisticated than the sponsors and employees of companies operating in other industries. So this is about the average employee working in financial company versus an average employee working in other companies. And we think that these people will have, basically financial companies will have a larger proportion of employees with financial education in the past, skills in that area, and definitely more prior experience with working with financial products and etc. So we're not very specific on the channel how greater financial literacy can influence the decisions, because there can be several things happening. For example, financially more sophisticated sponsors on a company level, they can negotiate better menus, better deals with the trustees. That's you have a question?
So just a question about your research, Christian, I guess. I would have thought that financially literate people, maybe they will not be as severely impacted by conflicts of interest, but maybe they don't benefit as much as illiterate people from having access to 401ks through which they can have menus of contracts that allow them to actually have a much better portfolio allocation along their life cycle.
So you want to say that they will anyway have access not only through the 401k? Or?
Like my recollection of Potterba at our results is that ever since there has been access to those 401ks with like those multi, life cycle products, people have behaved in much better ways in terms of how to allocate their portfolio along their life cycle.
Probably that's...
the first order I felt is actually might be better than what you expect.
Okay. No, so we look now a little bit at cross-sectional differences within sort of between those. And I think sort of going back to the channels, I think the first one is they can negotiate better deal. The sponsor can negotiate better deal with the trustees. Another thing that can be happening in the background is that the employees put more pressure on the sponsor and the trustee and get access to better deals. So they know which options are, let's say, better for them. So they demand that they are included on the menu or maintained on the menu, etc. And the third one is that given the menu that are of options within the investment menu, more literate employees can make better investment decisions. As I said, we don't really try to identify. At the end, I will say a little bit something based on the flow, how it relates maybe to some of these channels. The second thing that we try to distinguish is conflicts of interest. So for this, we try to examine the relation between the sponsoring company and the trustee. And within the sample of finance firms, we try to distinguish between firms that serve as a trustee of their own pension plan. So essentially, there is no independent party involved in the process. And finance firms that hire another external, let's say, another company to serve as a trustee of their pension plan. So our basically analysis will compare three types of firms or pension plans. One is finance firms that have an outsourced trustee, finance firms that have an internal trustee, and other firms, sort of non-finance firms, and they sort of by construction, all of them have another trustee, so they don't serve as the trustee of their pension plan. And our idea is that here, because there is no distinction between the sponsor and trustee, there is no independent kind of party involved, we think that the agency conflicts are higher. And in this group here, we think that a little bit the financial literacy of the average employee making decision is a bit lower. To give you an example of our setting, so this will be examples of three sponsors. So Goldman Sachs, State Street, and Intel. And all of them, let's say, have State Street as a trustee. So essentially, we think that, let's say, Goldman Sachs and State Street here will have a bit higher financial literacy of the employees. And we think that these two agents, the sponsoring company and the trustee, can monitor the actions of each other. And in the case like State Street and State Street, there's no independent party involved. And we think that the Intel employees have on average a bit lower financial skills than from the finance companies. So this will be our setup, and we will try to compare a lot decisions of these three types of firms. So to summarize our findings, we look primarily on a broad, we start with looking on a plan year level, so we compare allocation to employer stock, and we find that generally, let's say, financial literacy reduces exposure to options that are more susceptible to agency conflicts, but that works primarily when there is an, let's say, external trustee involved in the process. not when the trustee and sponsor roles are combined together. So we find that these finance firms with outsourced trustee, they have lower allocation to employer stock by approximately 5.2 or 6.9 percentage points. They have lower allocation to options affiliated with the trustee. Again, the magnitudes are quite large, around, let's say, 13.9 to 16.8 percentage points. Within the options, so we can look at mutual funds, deletions and additions from the menu, we see that they are more sensitive to performance and they are less likely to favor trustee-affiliated funds. And of course, I mean, these deletions, additions will be beneficial if there is some kind of persistence going on. And we find that they remove options that underperform, are more likely to underperform in the following year. So in that sense, it seems that this is not just wasteful rebalancing around. So to start with, our data comes from the Form 5500, and then it's Schedule A, schedule of assets, etc., that is held at the end of the year. So this will be the attachment. And what we try to do, because it's a, let's say, time-consuming process getting that one, our approach for the beginning was to start and let's try to get the data for the largest firms. And we wanted to have a little bit of balanced composition of finance and non-finance firms. So our sponsors, in terms of total, let's say, pension plans, we have 144, so it's not a huge number. But in terms of assets under management, they have around 800 billion at the end of 2016. So that would correspond to approximately 17% of the assets of the 401k industry. So in that sense, I think economically these are large plans. We don't have small plans in the sample, definitely not at this stage. Now, how do the menu looks like? So this, the first one is like plan size. If you can see, so for the non-finance firms is a bit larger. So the mean one has around 6 billion of assets, the median 4.1. Then the finance are a bit smaller because of course we look only at one industry and we try to get the same number of plans. Then in terms of number of options, the finance firms, they get more longer menu, more to read, more to scroll down. So they have around 29, 30 options. Here a bit more variation, 30, 40. For the non-finance is around 24. The dominant option are mutual funds. So they will represent approximately 80% of the options on the menu and also around 80%, 70% of the allocation. The other things that we have is like cash funds, participant loans, sponsor equity. Of course, by construction is only one option, but it attracts quite some flows. Then we have insurance products, self-directed brokerage account, etc. So this is how one menu will look, and this one actually fits on the slides because it's like 20 options. So most of them will be longer than this and hard to include it. But these are the things that we try to focus. So this is of Target Corporation in 2010. The trustee is State Street in this case. And these are the things that we try to look. So this will be the entire menu. You see there is a bunch of like target date funds. I will get back to them later a bit. But these are the, what worries us, let's say, options that we try to examine later as proxies for more susceptible to conflicts of interest. First is allocation to sponsoring equity, which in this case is rather high. So, and we know that, let's say, that can be problematic. And the second one is allocation to options affiliated with State Street. I personally don't think that these are like bad options that are included, etc. Here, I just use it as an example, what we would think more as options susceptible to conflicts of interest. And this is how the data will look, and we will focus a lot on these allocations here. First on this allocation to employer stock, and then basically adding up this allocation to options affiliated with the trustee or subsidiaries of the trustee. So to start with, we'll do 3 tests. The first one, as I said, focuses on allocation to employer equity. The second one will look allocation to options affiliated with the trustee, and the third one will be changes in menu over time, so trying to look at deletions and additions of options. So first, allocation to employer equity. I think from a perspective of the sponsor, this can be beneficial because the basic thing is it aligns the interests of the employees with the shareholders, so they want to increase the share price. Second thing is there is some evidence that it also can serve as a defense against takeovers, that it puts kind of like the ownership in friendly hands. However, it is costly for the employees because, of course, their human capital is highly correlated with the performance of the sponsor. And there are famous examples with the Enron employees that held large part of their retirement savings in Enron stocks. So when the company goes down, they lose their job at the same time as well as their retirement savings. So that's not good. On the other hand, there is some evidence that employees actually, if the employer stock is included on the menu, they tend to voluntarily contribute even more to the employer stock. And finally, let's say there is a large losses from this loyalty to the employer in that sense. What do we see graphically? So I intentionally scale them to 100% because there is a lot more on the menu, right? So this is just a small part, but it is sizable given that it goes into one company. So these are the finance outsource group. They have smallest allocation, and for the other groups it goes up a bit. For the outsource, for the non-finance companies, it will be around 15-20% of their allocation. So in a regression analysis, in the first column, we look at probability that you offer employer stock on the menu. We don't find, so this is a logic model, we don't find significant differences there, although the magnitudes will point that the other, like non-finance outsource and finance in-house, they will get a bit higher. Looking at the percentage allocation, we start first with all of them, then we focus only on those that add, and then on those that add, but that we can match with some other characteristics on the performance of the sponsor. So I think the last column is a bit more representative. So what we find there is that, let's say, the pension plans, so the participants in pension plans offered by non-finance firms, they tend to allocate 6.9 percentage points more. Yeah.
Just a clarifying question. Have you limited the sample here to only those that have the option of putting money into employer stock? Or is this a mix of sort of extensive and intensive margin?
The last one is only those that can put it.
Okay.
So the last two are only those that can put it.
Okay.
This one is all of them, essentially, even you cannot if it's not on the menu.
Yeah.
And these two are if it is on the menu.
Okay.
Yeah. So we find the differences there for the finance in-house. So these are employees of finance firms with their own trustee. We find that they invest approximately 5.2 percentage points more to employer stock. Looking at controls, I think they're in line with prior literature in the sense that if it's a larger sponsor, a larger company, it receives higher allocation, and if the, let's say, past standard deviation of the employer stock, if it's higher, it's perceived a bit as more risky by the employees and they reduce their exposure. So I think it's in line with that one. But I think in terms of economic magnitude, this is a rather large shift of retirement savings towards the employer stock. Now, the second question is allocation to options affiliated with the trustee. And here, the vast majority of them will be mutual funds. There are some insurance products and self-directed brokerage accounts that will be there, but the results are primarily driven by mutual funds. So let's start again graphically. As I said, mutual funds are the dominant option on the menu. They represent around 80% of the options offered on the menu. This is primarily about the trustees because they are typically mutual fund families that have a lot of mutual funds in their portfolio of financial products. And for them, putting mutual fund on a DC menu, on a 401k menu is very attractive because it kind of enables them to have stable assets under management, as prior research shows that DC money or 401k money tend to be very sticky. So in the sense, if you can put your option on the menu, you can ensure kind of stable assets under management, which is good for asset management decisions and compensation, etc. And then there's some evidence that the trustees also, which is problematic for the plan participants, tend to favor, let's say, own mutual funds in the sense when eliminating based on past performance, they can give more, let's say, kind of an easier time to their own funds and be more reluctant to remove them from the menu even if they underperform. So this bars, what they show, the left one is percentage of options offered, the right one is allocations, so from the total. So as you see, now again we are to 100, so you see most of the money goes to mutual funds. The darker part of these bars is funds from the trustee, the lighter part is other funds from other mutual fund families. And we see quite a sizable gap there. So in a regression setting, how much is that? So again, the first two columns look at probability of offering, and the other two columns at percentage allocation. I think the results are fairly close in both of them. And approximately, let's say, for the other two groups, so these are non-finance firms with an external trustee and finance firms without an independent trustee, they offer 16 percentage points more options affiliated with the trustee. And the allocation to these options is also higher, approximately 13.9 to 16.8 percentage points. So roughly that would be $1 out of $6 more will go to this option. So in that sense, the trustees manage to get more resources, more assets under management. Now the third one, we look at changes in the list of options on the menu. For this analysis, we basically focus on the subsample of mutual funds. And for them, we are able, large part of them, to merge them with crisp mutual fund data, and that enables us to attract basically additional control variables. So I will get to that in a second. The things that we look is the deletion or removal decision or the addition. And then it's the idea that we try to focus on how sensitive are these deletions to past performance as well as to the being affiliated with the trustee. In both cases, looking at the performance-induced changes, I think it's important to emphasize, like, they will be beneficial if, essentially only if there is some kind of persistence in mutual fund underperformance or performance in general. So that's why we'll run a test also to track the performance of these mutual funds in a later period. Otherwise, if there is no persistence at all, what we are looking at is essentially like unnecessary rebalancing and maybe exposure of the plan participants to too high costs. So the control variables that we get here, the performance, when I say performance, let's say on the next slide, that will mean for a mutual fund, the percentile ranking based on the returns in the previous 3-year period within funds from the same style. So we start with this very simple definition. At this stage, we don't do extra risk adjustments, factor adjustments, and so on. We look at some additional controls that we include is percentage allocation to each option. I think this is important to capture the relative importance of the option. If it's a very popular option that attracts a lot of flows, we expect that it's less likely that it will be kicked out from the menu because there will be much more pressure from participants to keep it in. Then we also include an indicator variable for target date funds. The reason is that target date funds, I think most of these plans will adopt them now as a default option, so you can expect that they stay there. And the second is that they come in a series of options, right? And every couple of years, you need to add a new target date fund to match the retirement age of newly employed plan participants, sort of the young plan participants that have a more distant, let's say, retirement horizon. So that's why we do expect that they will be less likely to be deleted, because it doesn't make sense just to delete one of them. You either delete all 10 of them or none. And then they are more likely to be added in the sense that you, by construction, need to add a new fund every, let's say, 5 years, I would say, or maybe sooner. So, and then in addition to that, from CRISP, we get other characteristics like mutual fund size, turnover, expense ratio, and investment style. Investment style in this case will be very basic, like five styles. I think it was like a balanced fund, which invests in both bond and equity, bond fund, international equity, domestic equity, and other. So let's start with deletion. So this is again a logit regression where we look at probability that a mutual fund is deleted from the menu. And here we report the marginal effects. The baseline probability that a fund is deleted from a menu in year, let's say, T is approximately 9.75%. So this is, that's why it's interesting to compare the effects relative to this one. We see that performance is negative. What it suggests, if your performance ranking is higher, then the probability that a mutual fund is deleted from the menu is lower. And we can see based on the magnitude, if it really goes up from 0 to 100, let's say that was 0 to 1 in that ranking, you have more or less, you remove all the baseline probability. You will not be deleted. However, what we look is more on this sensitivity across the plan types. So if we look at this column 2 or column 4, we see that the probability seems to be, the performance sensitivity is strongest for pension plans sponsored by finance firms and trusted by an external company. It is significantly, let's say, reduced for non-finance sponsors. So there we see that these deletions, removals from the menu are not sensitive so much to past performance. Regarding trustee affiliation, what we find is that basically, especially I would say the finance firms with internal trustee, they're more reluctant to remove trustee options from the menu than the other groups. So this suggests that the fact that the sponsor and trustee are the same entity kind of, my interpretation will be, gives them more incentives and power to keep these options on the menu. Now, going forward, the next analysis is rather similar. It focuses on additions. The only difference is that now, with additions, we need to assume something about the universe of funds that can potentially be added to the menu, right? So because for deletions, you can delete from what's already on the menu, whereas for addition, the opportunity set is very large. So we assume that the universe is limited to mutual funds that have been offered by at least one pension plan in the sample. So this will be, and this again, immediately you can see inflates the sample because it creates a lot of relations. So it goes up from like 13,000 here to 1 million because it creates a lot of relations that will not happen. And again, because of that, the baseline probability is tiny, so that the mutual fund is added. So that's why we don't show marginal effects because there will be a lot of zeros, so that I can consider multiplying the dependent variable. But we show just the odds ratio to look at these relations. So what we find, what predicts an addition of a mutual fund to the menu? Past performance is a very strong predictor. So this is similar, like even in any asset management decisions, like also looking at defined benefit pension plan or sovereign wealth funds, they hire managers based on past performance. Now, the only thing where sort of it doesn't go through is with finance sponsors with in-house trustee. They're less sensitive on past performance with adding options. So that in that case, it's not such a predictor. The other thing is like we see that the trustee option, the baseline effect is significant. So trustee funds are more likely to be added to the menu for all types of pension plan. But then the interaction term finance in-house trustee option is also highly significant. So suggests that especially in this case, trustee options are much more likely to be added to the menu. So the trustee affiliation plays a role. As I said, like these menu changes, I'm not a big fan of them because I think it exposes you to a lot of rebalancing. You need to move your assets from one mutual fund to another one, etc. And there is rather weak evidence of performance persistence. I think in this case, we do observe some performance persistence, and I want to emphasize this is not alpha persistence or something like that. This is just ranking within that investment style. Now, what is also interesting is we see some evidence that for finance outsource firms, the deleted options seem to be more likely to have lower future performance. So we can think that at least for them, let's say the deletions make sense. We find for additions, we find nothing. So the funds that are added, they had good past performance, but that's not a guarantee for going forward. So it seems that at least the deletions for finance firms with external trustee add a little bit of value for the plan participants. Now, the final thing that we do is we look at flows. And I think this is may suggest about something about the channels that play a role and how these things shape. Because as I said, for financial literacy, etc., we don't know whether it's the sponsor putting more pressure on the trustee, whether the employees putting more pressure on the sponsor and designing a better menu, or the employees within making certain decisions. I think the results on flows suggest that most of the, let's say, asset allocation and flows are driven by menu changes. The last two columns look at participant flows, and I can already tell you there is not much going on there. So the way we measure, we look at the flow basically that enters into a mutual fund compared to the previous year. If a fund is essentially deleted from the menu, this will be automatically like the flow will go to 0. If it's added, it will be 1. So if we, or for deleted, it will be -1. For the added, it will be +1. So in the last columns, we remove these things when the flows are on the maximum, so we can look at decisions made by plan participants. So what we see is that there seems to be a lot of performance chasing behavior, sort of performance-induced flows. However, they're largely by these menu changes. If you look only at participants' flows, there is not much going on. But the menu changes create a very large performance-induced flows. And as I said, with the trustee options, there is not too much. They get a bit less flows in this case because they are more likely to remove them. They don't favor them so much. But in general, this suggests that if you want to influence sort of participant decisions, the primary, let's say, way to do it is by looking at the menu design. At least suggests to me that it's looking at the menu design, and on the participant level, you will not get so much action. So in conclusion, what we find is that, at least the way we interpret the result, is that financial literacy among plan participants and sponsoring company can potentially reduced exposure to options that are more prone to agency conflicts. What we find is that plan participants of finance firms that have also an external trustee, they have lower allocation to employer stock, lower allocation to options affiliated with the trustee. Their mutual fund changes on the menu are more sensitive to past performance. They're a bit less likely to favor trustee funds. And from these changes, they seem to, let's say, benefit a little bit from by removing options that underperform in the following year. I think some, let's say, implication is that financial literacy can help basically achieve potentially better outcomes, but it cannot do it alone. You need to also look at the governance structure of these 401k plans. If it works better when there is an independent external trustee, if this trustee and sponsor role is combined under one roof, sort of, it's a bit harder to see outcomes. So that's why we see such large differences between the finance firms with internal trustee and finance firms with external trustee. I don't think that there is too much difference in the skills and the experience of their employees. So in that sense, I think that it is a little bit that a lot of attention needs to be devoted to the institutional, organizational side of DC and 401k retirement systems. Thank you very much.
And I should mention that Bertrand is stepping in for the previous discussant who had issues this week, so Bertrand got the paper just a few days ago and was kind enough to provide a discussion, so thank you.
Yeah. Thank you, Philippe, for apologizing for me from the start, but I hope I will do a good discussion anyway. So thank you, Aleksandar, for the paper. It's actually been a nice read, and I learned a lot of stuff. Do you have a comment? Thank you. So I'm going to start with the structure of my discussion. So I'm going to focus more on the first part of the presentation, which is, and actually I'm going to focus only on this, which is the investment menu design. So typically, how the nature of the sponsor and the trustee and the relation between the sponsor and the trustee affects the menu design, and how it affects the final choice of participants into different assets, which is in the menu. So by doing this, what I will try to look at is actually try to understand some of the mechanisms which are behind your results. And I think in some cases I have a little bit different interpretation that what is in the paper. And I thought that actually your presentation was more going in my way than actually certainly first draft of the paper. So I will say some stuff that when you read the paper are very relevant, maybe a bit less now, but I think still some of them are relevant. Nonetheless, I think that the second part is interesting and it brings support for some of the ideas that you have and that you point out, so I have no major comment on this part. And overall, I really enjoy the paper. And the potential improvements I would suggest are mainly to give additional details on some parts, and also with respect to the understanding of mechanisms, I think you can leverage a bit more on some of the data that you have, and actually I will point out this in the discussion. So let me start with the general framework and the way my reading of the paper was when I read the paper, the framing I had in mind. So typically you have a sponsor and a trustee. They can be the same entity or not. Actually, they can be the same entity if this is a financial firm. And both have incentives when they actually design menus. The sponsor may want to actually sell some of the stocks to employees, actually to reduce the risk of takeovers, for instance. And the trustee may have incentives to sell its own mutual funds to make money because they make money out of it. And based on that, so based on the structure, who is the sponsor, who is the trustee, and whether they are the same or not, and the incentives, this may affect the menu that is offered, which is a set of assets, mainly mutual funds. Also, one point that is not tackled in the paper, but you mentioned a bit, is also how I don't know how the menus are presented, but also possibly you may have an incentive to present, if you're a trustee and you say you have different you offer different mutual funds in the menu, you may want to insist on your own mutual funds. So maybe you have something going on there, but don't see. So the menu plus the literacy of participants. Based on the menu and the literacy of the participant, they're going to make choices, and they're going to choose the allocation of their assets. One point, so the thing that you mentioned a lot in the paper is that the literacy of the participant may also affect their knowledge about the incentives of the sponsor and the trustee, and that actually based on this they may influence this relation, and this may affect the menu. So you have a kind of a loop here, and that's what you insist on in the paper. And so the main takeaway, I think, is that sponsors that you put forth, the main empirical evidence is that you show that sponsors belonging to the financial sector and relying on external trustees tend to offer better menus, and this results in better asset allocation of participants. So I think that's kind of the major empirical result. Then you have a different interpretations, and that's what I'm going to look at now. So just on the data part, I'm doing a small parenthesis here. It's not really clear from the paper how the sample is selected. So you have two types of firms, financial firms and non-financial firms, but within financial firms you have two types, which are act as trustees, and those who rely on external trustees. And the sample on those who rely on who are both sponsors and trustees is actually quite small, and I wondered if you actually could have more firms of this type in your sample, because some of the results for these firms are insignificant, and I wonder if it's due to a lack of power because they are so small in the sample. So one thing which is not tackled in the paper and that you don't really mention is, do we have any idea about the reasons explaining why some financial firms end up to be trustees and other not? Meaning that, do we think that actually the structure of this, whether the sponsor is also a trustee, is it also a consequence of the financial literacy of the firm, of the average participants in the firm? So typically, what you take as a given is this structure, whether actually the sponsor is also a trustee, and then you say that, well, the literacy of participants may affect the way this relation works, but actually whether the sponsor and the trustee are the same or not may also be linked actually directly to the literacy of participants. So you take this as a given and you don't actually take this into account, but I think this may have an importance in the interpretation of your results, because the two type of financial firms that you have, those who act as trustees and those who don't act as trustees, may be actually different firms. Because so I wonder if you have something to say about that. Maybe they are not so comparable to each other. Maybe the level of literacy of participants is not the same. So then I'm just going to go quickly on this one. You showed actually these figures about the number of options. In your regression, you always control for the number of options here. Typically, it seems that financial firms tend to offer menus with more options. So, should it really be a right-hand side variable? I think it should be more on the left-hand side, but then it could affect actually some of your estimates on the effect of financial outsource. For me, these are two outcomes of potentially being a finance outsource firm. More importantly is this table. So here you have options affiliated with the trustee. So here you have these two columns is the percentage offered by type of firm. So how being a finance outsource affects the proportion of assets on the menu which are options affiliated with the trustee. And on the right side, you've got the percentage allocation. When I look at this table, if I were removing percentage offered and percentage allocation, the other words, I would think it's the same regression. You see the coefficients are really the same almost everywhere. And so my question on this was, regarding options affiliated with trustee, is the allocation actually almost entirely determined by the menu? Because when I see this, either it's pure luck that these coefficients are so close, or it's just that people typically they have a menu, they chose assets randomly in this menu, and so when they have on the menu more options affiliated with trustee, they end up having more options affiliated with trustee. So typically, it would mean that everything is determined by the venue. And that actually financial literacy after that doesn't play any role anymore. So you know, and a simple way to look at this would be to check at the correlation between the percentage offered and the percentage allocated. So do you have a high correlation between these two figures? And I would be interested to understand if this correlation is actually pure luck. I mean, these very same numbers is pure luck, or if it's telling something about the mechanisms that you have actually behind your data. On the other hand, if you look at allocation to sponsor equity, what you find is that, so here in these two columns, here, so it's a percentage allocation of assets allocated to sponsor equity for finance outsource. So the two first columns are including all firms, so those offering sponsor equity and those not offering sponsor equity. And the last ones are just for actually firms offering sponsor equity in the menu. And here you see that apparently offering or not sponsor equity, I mean, this selection doesn't really affect your coefficients. So it seems that it's actually not the case here. So you know, maybe actually financial literacy still plays a role even when you have sponsor equity in the menu. So what does it tell about the potential story that you have here? So my interpretation of these features of the data is that the possible story actually behind this is that literate participants know the incentives of mutual funds, and so make sure that the sponsor controls for that by appointing the right people. So that would be your story of like influencing the sponsors. So if I look at my table 3 that I was showing before, I would say, but maybe they are unable to discriminate between mutual funds themselves when they are presented to them like this. It's a complicated task. I mean, I may know the incentives of trustees to sell their own funds, so I may insist on my company to actually do the job to actually control for that. But once I'm dealing with different mutual funds, I may not be able to discriminate which ones are the good ones. So, on the other hand, yeah, it's quite easy for someone with some financial knowledge to know that it's not a good idea to invest in sponsor equity because you correlate. I mean, you add the same risk to your labor market risk. So this is an easy task. So I think there is a different mechanism going for mutual funds and sponsor equity, and I think that could actually be dealt with a bit more in the paper by looking more at this part of it. Thank you very much.
We have time for questions from the floor.
Yeah, so first I want to thank Bertrand for preparing a great discussion, especially if it was last minute. I highly appreciate it. And I noticed that you also got the older version of the paper, sort of something that we initially submitted, I think, for the conference. So that explains your frustration with the writing. I hope the thing that we finished like a couple of days ago and sent it to Stefan before the discussion is better. Will not frustrate you so much, but apologies for that, and thanks for putting effort. To add on some points, yeah, so I think on the how much we can expand the sample with finance firms that serve as a trustee on their own plan, not much actually, because in the sample we have 28 unique trustees. And I think there are other papers that have looked at this, and it's a highly concentrated business. I think there will be 30 or so serving all plans more or less, and the top 3 or 4 will have a giant market share. So I think it's we will not be able to add more firms there. How we started collecting the sample, we basically took the mid-year in our period, like 2013, and then we said, okay, let's rank finance and non-finance firms from the largest plan towards the smallest. And we started getting for the largest. We want to have the balanced group of finance and non-finance. With the finance one, we really try to go after as many as possible that are serving as a trustee. And out of those 28, 21 were serving as a trustee of their own pension plan and had a 401k plan. So there are very few of them that will not do it, to answer that part. Yeah, so I think points well taken on the interpretation. I think your reasoning is going into the line of direction that we see. Like for mutual funds, it seems that it's highly driven by the proportion of trustee funds that you have in the menu. The coefficients are indeed really close to each other. And for employer stock, there is a bit more differentiation there. Thank you. Appreciate it. Yes.
So this is a topic very near and dear to my heart because I've been looking a lot at pension investments over time. A couple of thoughts. If you look at the micro literature on participants in pension funds, there's very little evidence that participants change their asset allocation at all. Even during the financial crisis, there might have been at most 2 or 3% of the participants. So there's tremendous inertia. What this suggests to me is that what's much more important is the choice architecture that the employer puts in place, which is auto-enrollment, target dates, mapping. So very often the employer will say, get rid of these funds. The employer says, get rid of these funds, put in the other funds, and just shuts down those available. So when you see asset flows, it's not that the participants are necessarily doing it. Related to that is typically the way employer matches get, in my experience, is that employer matches tend to be in employer stock. And with the inertia that we've already mentioned, it's likely that people are just going to stay there. And then last, I was going to ask you, I presume that when you're looking at performance, you're looking at gross returns. But what you really want to look at is net returns, because there are huge differences across mutual funds and other assets. And in fact, there's another player in that mix that you might want to look at, which is the role of the consultants. So typically maybe not financial firms, you'll have to look into it, but firms will say, we need to hire a consultant because we don't know what funds to put in the menu. And therefore, we'll hire the consultant to tell us the best set of funds, but the lowest cost, with the best diversification, et cetera.
That will not be the trustee.
Huh?
That will not be the trustee.
I agree, that's why I'm saying you're missing another party in the decision. I think in a few cases the consultants do take on the role of trustees, like financial engines would, but not necessarily all the time. So a couple of different pieces of the puzzle.
Yeah. No, so for the first one, I agree that what we also see with the flows, it's primarily about the architecture. So that's what we see there as moving things around. Regarding performance gross net, I did not show the results for expense ratio, but what we see, it's a very strong predictor of whether a fund will be removed or added on the menu. So I think there is a pressure, and the magnitude, so you see that the funds that are deleted from the menu, they're expensive funds, and the funds that are added typically will have a bit lower expense ratios. The returns, I will need to look into that, how they're estimated. We try to be as precise as possible in matching the expense ratio. So if a share class is mentioned, we go after that share class. If it's not, we assume that it's the institutional share class, sort of for that purpose. Yeah, the consultants, I need to look into that. I noticed that few of them have mentioned also advisor, but not every fund had in this, for at least in the Dole 4, mentioned explicitly that they have an advisor. Yeah.
Just a short follow-up on the share class point. There have been a lot of lawsuits in the U.S. over the last 3 or 4 years. Many universities have been served with lawsuits, including. And the argument has been that someone, the fiduciary, the employer, whoever, has selected the wrong share classes for large DC plans. And so I think that's a choice that I would also like to see.
That's interesting, because indeed we see sometimes A, B, C share classes popping up, which will be retail, and you would think they would be able, at least these largest funds, to get the other ones. Yeah. Thank you very much. Well taken. It's good to.
I just want to pick up on the same point, actually, because the issue of inertia is a deeply important one. We see this also in insurance plans dramatically. And I just want to, I don't want to suggest a magic bullet alternative explanation. I'm not doing that, but I am saying we have to be very careful here as we proceed towards the normative evaluation of those. And I take the point completely that you're both making, that choice architectures are mightily important. We know that empirically, but what to make of it in a normative sense. And the concern here is, well, there's one concern, and that is it's well known in the investment banking area in terms of advising that people will often churn, investors will churn after a crash, which is one of the worst things they can do. However, almost all of the literature in this that tries to be rigorous and write down structural models, and I'm thinking particularly in the area of insurance, the work of Ben Handel and others, attributes inertia to idiocy and stupidity and lack of intelligence, and just
Yeah.
you name it. You can even say present bias, you can say anything that's your fancy buzzword, shiny toy of the day behaviorally. However, they all ignore one simple explanation called intertemporal risk aversion, also known as correlation aversion. And that is, the reason they do that is because we often assume an additively separable intertemporal utility function, which implies intertemporal risk neutrality. Now, I'm not saying one should therefore go to the crazy Epstein-Zen type exotic preferences, but one can easily write down models that separate out atemporal risk aversion with intertemporal risk aversion. The reason that's deeply significant is because if it is a preference, and I'm not saying 100% of it is a preference, I'm not overstating the case, if there is an element of that inertia which is a preference for intertemporal, born of intertemporal risk aversion, and in health plans it can be because you've got your provider networks and all the other attributes, then it has dramatic normative significance. You cannot, as some have done, ascribe 100% of inertia to irrationality that has to be stamped out or nudged away in some unconditional manner. So I just want to caution, I think this is a deeply, deeply important problem. I'm not trying to belittle it at all, but I think we need to festine lente, let's hasten slowly when we start to do the rigorous normative evaluation of inertia.
I agree with you. You need to think a lot about it. I also think that there is like a jump between like inertia and then suddenly lawsuits. So that the plan participants are first very much like not rebalancing right, and eventually it boils down to lawsuits against the sponsor and the trustee. So I think that they're inert until a certain point, and then things can escalate quickly for the plan sponsor and the trustee in that setting. So I think if you push them too much, then you end up on a rather different spectrum. So that's why I say that it's a lot about plan architecture, but I think that the plan architects take a lot into account, like whether like lawsuit risk and other risks when designing this menu, because they know that if their plan participants are not happy with the decisions, they might stick with them, but eventually it may end up with very bad outcomes.
But I'm not sure, and I do a lot of litigation, I'm not sure that we'd like to use the judicial system as the metric for normative evaluation.
Yeah. I don't think
I'm pretty confident we don't.
Yeah.
More question? All right, well, thank you.
Thank you.